Good afternoon, or good morning if you're in Hawaii. Certainly, good afternoon if you're in on the East Coast and Central Time Zone, or good evening if you're in Europe. Joel, welcome to the show. It's great to
Well,
have
thank
you.
you, Rob. I'm delighted to be here. Thank you for having me.
Good, it's you and me today. And at this inaugural show, I want to talk a little bit about what the this show is about, what we hope to cover in terms of the credit world. Out from an outsider's perspective, Joel, I'll say this about credit. It seemed like I've gone almost over 40 years, and credit was kind of the sleepy backwater, of just a function of the loan that uh, you needed to deal with, but it wasn't in the headlines, and you kind of dealt with it and eventually funded the loan and so forth. And now it's taken on this whole different identity where it's in the mortgage headlines and a conversation topic that's out there. And what this show is meant to do is talk about credit trends in general, how they impact originators and lenders, and maybe some of the unintended risks of credit cost cutting initiatives that sometimes get bounced around in the press. We're going to talk about tri-merge data, some of the scoring models and so forth, maybe some regulatory pressures that the industry may be feeling, and so on. So I know we have a handful of questions we'd like to get to, but Joel, I'd like you to talk about how you got into this business and what you do at Equifax.
Well, thank you again for having us. We've enjoyed reading your publications every day and enjoyed your webinars over the years and appreciate the contributions you make to the industry. And so thank you for that. I have been with Equifax for about 10 years, but I took over the mortgage vertical about a year ago. And that was driven by our CEO looking to kind of restructure how we approach customers. Your point is well taken that credit just used to kind of be that behind the scenes, need it, order what you need, go with it, and run with it. And we know that we got a little bit disconnected from our customers and really needed to lean in regards to making it easier for people to understand all of their options, not only with credits, but with also with verifications and how we can simplify that for them and help them use it more. So we've been trying for the last year to really connect tighter with the industry and better understand the frustrations, the pain points, but also educate on the opportunities. And so that's really what I've been focused on for the last year. And there's a lot of history. There's a lot of, as you said, uh, being in an organization that seems to be making the social media post or the news on a daily basis about people having conversations or opinions. It keeps you on your toes, but it also has really done a nice job of making sure that we're focused on what the industry is upset about, what the industry is excited about, and how we can educate folks in other ways and different ways of doing things. So thank you so much for having us and excited to be here.
Well, you're very welcome, and thank you. So there are changes going on in the credit industry, and an example was the news of FICO Ultra that came out today. Was announced. I'll be putting it in the commentary tomorrow, but for today, I think that it is indicative of some of the changes that we might see. And I was going to ask you, I wanted to ask you, you're not here obviously to talk about the pros and cons of some new product that you haven't looked at from FICO slash Fair. Do you call them FICO or Fair Isaac?
I'm a FICO person. That's what I call it. I have not been in the data world long enough to default to the Fair Isaac name, but a lot of folks still do.
Yeah, I've spent a lot of my life in Marin County, just north of San Francisco, and that's where Fair Isaac used to be headquartered before. I think they moved to Montana a while back. So, but this ultra program that was sent out today, uh, can you talk a little bit about innovation and what products mean to the industry? Maybe not necessarily the new one that came out today from FICO, but just in general, why are we seeing this influx of innovation and change just in general?
Well, in general, I think it's what it really comes down to, Rob, is there's so much more data available, and more data does help make better decisions. And so, again, I'm not an expert on their product, but the fundamental, announcement is talking about pulling data from additional sources, such as potentially bank type of information, and using that to generate a score. And we've been talking about that for about a year and a half in regards to more data is better. So when we think about innovation, we've been focused on a few, really targeted areas when it comes to credit and data sets. And so we've been focused on providing more data elements with a standard credit report. And we still have a lot of education to do for the industry. But the reason we're doing it is we want to allow people to automate a workflow so they know what's available for them and whether it's going to pass some of the toll gates that are required. And we want to provide more data to make better decisions. So today there was the monthly updates in regards to underwriting policies, and we were excited that one of the additions we've been providing, which is telco, utility, and cable TV data, those attributes are now going in and being used for and analyzing a customer's ability to pay and their credit worthiness, because people believe that more data is better. So I'm actually very excited whenever I see anybody in the industry embracing providing better answers through more data and providing more data in a single view for a customer. And we've been seeing that in other verticals for quite a while. I think it's a great opportunity for mortgage to be embracing some of these. But when we think about the fintech world, where you seldom get to meet your customer face to face, it's all a digital experience. We see a number of clients that start with one small data element, and they expand, and then they may get to credit, and then they'll get to part of a verification. Then they're negotiating digitally to see if somebody signs up. Then they lock in those the rest of those data elements to firm up that offer and make sure that they can sell it on the capital markets. But we've seen that evolution working in other industries. And we're actually starting to see that same mindset come to play more and more in credit and mortgage, where a number of our customers are embracing the concept of being able to buy, a thin file, or I'm sorry, not a thin file, that's bad terminology. It's just a basic non-trended file with or without a score, just to determine credit worthiness of that individual up front, save that expense that comes through. And if they can move that individual forward, then they'll add those additional data elements to be able to give the firm offer at the right rate and to be able to close the loan. And that's not been an easy transition. There's a lot of challenges there with technology and other things, but the clients and customers in the mortgage space that have been embracing that have been able to control their costs a bit better and been able to interact with their customers to evolve that relationship step by step and expand that coverage of data and knowledge of the customer.
Yeah, I would say, when people talk about credit, obviously Equifax is at the center of many of those discussions, and you brought up data several times there in that explanation, and thank you for that. I'm an old capital markets guy. Data 30 or 40 years ago is a lot different than data now in terms of trying to hedge a pipeline, for example, or the kind of information that investors require. And I wanted to ask you about a potential small or large misunderstanding in the marketplace about how you obtain your data. Can you pull back the curtain a little bit on the data acquisition side of things?
Sure. So we have over 15,000 contributors to the credit report side of the house. So there's 15,000 different lenders that report, or servicers that report information. That represents about 1.9 billion transactions a month that we.
Wait a minute. So time out, Joel. 15,000?
Yep. And there's still more to get. So the other bureaus have contributors that we don't, and vice versa. There are mortgage companies. Some are second mortgages or HELOC type of lenders, but that only contribute to one credit bureau. So how do we get it? We have a very large, I would refer to it as a sales organization, Rob, that's always out working to earn the trust of lenders and get them to contribute and talk about the benefits of contributing. But there are some that only contribute to one or two. And then there's some that we all know the big guys contribute to all three and really abide by it. And that's where some of the risk lies. Is there used to be, if you go back, 15, 20 years ago, there used to be a much more disparate credit bureau space, meaning there was a number of other players and many were very regional. And as those kind of got consolidated and rolled up, in some cases, we were able to get more data and to get more normalcy between the three. However, in the last few years, we've actually seen a divergent from that as we've seen a change in the type of lenders that people are choosing to do business with. So you now have buy now, pay later vendors. You have some of the more of a payday type lender. You have paycheck lenders. You have other programs that don't report to all the bureaus in a consistent fashion. And so, one of the other credit bureaus may have a big client that does a lot of buy now, pay later that I might not have right now. But at the same time, I might have, coverage for auto throughout the eastern half of the United States that brings in a lot more trade lines than one of the other bureaus. And so those trade-offs occur across the space. And we all spend a lot of effort because we want to get as many as possible. We want to have the most thorough view of a customer as possible. But we still have some gaps in regards to what each organization sees. And then there's also technology gaps. I think one of the things that folks don't think about wholly is that there's a lot of technology. When I talk about that 1.9 billion transactions getting updated every month, think about how many times your VPN doesn't quite work the first time you log in, or you can't get into the meeting and get your camera and your microphone working correctly. You got to tweak that. You'll see that. You'll see that variance between different credit bureaus on different days, whether things get updated or whether there's delays or challenges there. And so that variance causes some uncertainty, and that variance also causes challenges in regards to giving a consistent and best offer of credit. So what we've actually seen across the industry is I got myself a new credit card last week, and I was really kind of surprised because I got it from a bank that I had another line of business with, and they still chose, and I have a decent credit score, they still chose to pull 2 credit reports on me. Because they knew that there's a little bit of a difference there. And so we're seeing it in all industries that people want to make sure that they're getting the best view of a customer as possible.
So I'm going to go off script here a little bit.
Okay.
And then we'll resume. But let's say I'm a loan officer or dealing with a whether mortgage loan officer, whatever, at a credit union or bank, IMB, whoever, and they're sitting across from a client talking about the loan process and so forth, and I'm the originator, and I say, we're gonna pull credit and take a look at that, and the consumer says, well, what's going on? I hear this stuff about credit reports in the headlines. What if my credit's bad? What do I need? Should I be concerned that you're pulling credit? Is that bad? Is that good? I mean, what is the a good basic conversation for an originator to have with that customer to say, okay, the credit process is an important part of the whole thing, and here's what's going to happen and why. If you were an originator, what message would you want to know to be able to tell that client?
Well, I think there's a few different angles of that, but I'll start with, again, a real life experience that if you're talking to somebody brand new and you don't know, we've seen it become very common for when it's a personal relationship, when it's not just behind the scenes of a computer interface, but you're actually working directly with a loan officer and having the conversation. Many will ask, hey, are you on Credit Karma? Or do you know your score from a credit card company that maybe shares your score with you? They actually start with the dialogue of seeing whether the customer understands that or if not. If the customer does, they can start the dialogue with a pretty intelligent footing to say, oh, wow, Credit Karma says you're an 820. That's probably pretty good for us. We really want to get to know you better and get this loan going and get it wrapped up. At the same time, if they say, hey, I saw it, I'm like a 480, that's a challenge. We all know that's a challenge. Doesn't mean you can't get the loan done, but it's going to take a little bit more work. But we're seeing a number of clients think along that mindset of have the dialogue first and see what the customer knows, and then start that journey based on that starting point. Now, one of the things that we've seen and heard a lot of feedback that's caused some friction is historically, we've heard people will say, hey, my credit score, again, going back to the Credit Karma concept, my credit score was an 800, but you did pull my credit. Now you're saying I'm a 760. What happened? In some cases, that's the difference between the FICO Classic score that might have gotten pulled, and they see a Vantage score there on the Credit Karma site. So with the adoption of two scores now, in many cases, it will allow loan officers to have that dialogue of explaining some of those differences, but also getting that input from a customer to help them get the best loan possible with the best terms possible. And it's again, you started the conversation with a great topic of innovation, and the older score models have really not been touched much for 25 plus years. The new score models, whether it be Vantage or whether it be 10T, take in a lot more data and are more predictive across the board. And so that acts as a positive for those folks, especially those folks that have been cognizantly working to ensure that they have a credit score that they can go apply and be approved for a mortgage.
Yeah, I'm still reeling from the comment about 15,000 sources. You hear these things like, oh, let's take this kitchen counter and we're going to pour bleach on it and we're going to scrub it with we're going to put a blowtorch over it. And look, there's still, a billion bacteria left on this kitchen counter. And it's always, you're always amazed at these statistics. Like, wow, I thought that kitchen counter was clean. When you talk about 15,000, I would think that many people would be hard pressed to mention or to come up with off the top of their head 20 or 30, mortgage servicing companies. But that doesn't even scratch the surface. I'm sure obviously there's all kinds of credit cards out there with banks and with like companies like American Express and so forth. And all of this data that's out there, as we said earlier, the way that data is looked at and analyzed and the amount of data is way above where it was even 5 or 10, 20, a long time ago during the Hoover administration when I started in mortgage banking. Things have come a long way since then. But we sometimes I hear about credit data being a commodity. And you brought up the term thin file. Maybe it's not thin files isn't the right term, but I'll use that term anyway. But if a consumer has a thin file, for example, at one bureau and a more robust file at another bureau, how does that impact the consumer's chance or ability to obtain financing? I'll leave it at that.
No, so that's a great question. And one of as you brought up on the 15,000, one of the groups of organizations that contribute to that is we have a lot of wonderful credit unions across the country, but many of them tend to be relatively small with maybe a few hundred, a few thousand members. And so they have a much different footprint than one of the large national or super regional banks and how you think about them and how they post. So it is not uncommon, Rob, where you might have someone that's done a lot of their banking through a smaller credit union in their local area and maybe has one or two national cards or an auto loan through a national lender. And to that point, that individual, those three credit reports may look very different if that credit union who someone's done banking with for a number of years is only reporting to one or two of the bureaus. And that's why the current model really was set up the way it is to take a look at all three of those snapshots and pick the middle one so that you're giving the best opportunity. The other thing we see in regards to that is because it is expensive, and we know that the economics has changed tremendously, and that's why we've been looking and working to say, how do we help across the board, and how do we help educate using data differently. But that scenario is one why people will start to build their own rules. So if I have 9 trade lines, for example, and again, I'm a 750, we do have clients that'll wait until they get into that underwriting phase to get the second or the third credit report, because they feel comfortable in the band they're going to be in, especially if the debt to or the loan to value is going to be lower there. If it's below 80%, they start to feel pretty comfortable about where they're going to fall on the LOPA tables. But it's not until they get all 3 of those that they can really know that they're providing the best price to the consumer and making sure that they're getting the right risk profile. So it is a lot. It is a lot of contributors. There's still a lot of nuances in it. I can tell you that competitively, the 3 bureaus are fighting all the time to get every contributor possible. We see each other doing so. We take pride, and I would say that when you talk about the credit union space, a few years ago we had some room to gain there, and we, as an organization, really doubled down, started investing a lot more to try to get credit unions to come in and attract them, and not only as customers but as contributors to the credit bureau at Equifax. But to your point of earlier, and really kind of the genesis of your question was around the commodity. The concept is a commodity. The actual delivery of the product, the level of security, the level of trade lines, the responsiveness of each bureau is different, and there's a lot of competition there. The other thing I would mention is when we look at our business today, even in mortgage, where there's been many narratives that have been expressed that, oh, they don't have to compete, it's guaranteed, da 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 da. That's based off of a little bit of ignorance. When I look at our business, a very healthy part of our business is competitive for one bureau. More than 25% of our revenue is coming from fighting for that first position of selling that first credit report to determine whether somebody is credit worthy or not. And, the 3 bureaus are fighting for that first position all the time, and you win some and you lose some. And that's why we made the decision, about a year ago, is that we wanted to start including some of the telco and cable and utility data with our credit report, and we wanted to start including some elements from our twin database, the work number, to tell people how long somebody's been employed, where they're employed, and what income was last year, is to help add value to that credit report at that early phase, so you can understand a customer enough to know, is this a good opportunity for us, or is this one that is going to be really challenging and maybe we need to put over on the sideline. But that's been our approach to it, and both Experian and TU are taking similar approaches with data elements that they have or attributes. But I've seen that be, what I believe is good for the industry. It's not fully adopted by everybody, but that nature of how do we provide more value up front with the standard credit report is something that I think is beneficial to everyone. And as people become comfortable on how to use that data to make the next decision, people are going to see that they can save quite a bit of money and control their process and even automate their process, which again goes to that innovation. Part of the reason that we chose to provide the data elements that we do with our credit report is to allow people to automate that loan process and make a decision digitally on the next time to pull the next version of a verification, for example, and know that they're getting it at the right time and they're not spending money before they need to, because they know that right information is there.
Yeah, I would say that when people talk about educating the industry, you guys at Equifax do a lot of that. And once again, I want to thank Equifax for sponsoring the show. The information that's out there is almost overwhelming, and you brought up the cost. I mean, people talk about the cost, and people point at Fair Isaac, and they point at this and point at that, and so forth. And there are other people who will say, well, gee, if somebody's getting a home loan the cost of insurance far outweighs the cost of credit. It's not even funny. Why are we talking about credit? Period. But that's more of an insurance call than a credit bureau call. So, but I did want to ask you about the the cost, the price of credit reports. Can you talk a little bit or a lot about let's say the work that Equifax goes through that is kind of behind the scenes? Is it like, the proverbial duck crossing the pond who looks very calm and sedate, where if you look underwater, the duck's paddling furiously, you just can't see it. What hidden work is involved in producing a product like this? And can you talk a little bit about, along those lines, some of the cybersecurity efforts that you have to go through in order to put out a reliable, safe product to the industry?
So a lot in that question. So I'm going to try to touch on all of it because there's a lot of good doors that you open there, and I appreciate it. So let's start with the cybersecurity piece. I mean, again, it's no secret that we made all the headlines in 2017, and our board and leadership said that's never going to happen again. So we're going to invest. We are going to make ourselves leaders in the industry, and we are going to ensure that above all that our customers are protected, our consumers' data is protected, and that we're doing everything possible to ensure that that any bad actors are locked out of the equation. And that is, that's a standard that we are unwavering on. But that does obviously come with a big cost. That cost is spread across our entire business, not just mortgage, which our mortgage credit side of the business is less than 10% of all of Equifax, which is really important to us. Don't get me wrong, but it's not all of it. So that gets spread across, but there's a lot to it. Some of the unique things about the mortgage ecosystem is all of the platforms that all of the mortgage bankers and brokers use. Those platforms have to have integration to them. Those platforms may have technology fees or click fees over the year to help ensure that all of those are being done right. There's audit costs between all of those platforms. And then, of course, we're mirroring everything we do there, pretty much going back to the GSEs with data through a secure pipe so that the GSEs have that security of knowing none of the data is being manipulated. They're getting the exact same raw data file that we're getting from the lenders, and that's coming to them, and it's not there's no area for manipulation or change on that through the ecosystem. And so that's a bit unique, but it was built to build a secure, robust, knowable system that really cannot be impacted. But with that, there comes kind of an expense and a cost that we make each step of the way. We also are very strong supporters of the industry in regards to standardization and other things. And there's a cost to that. It's a cost that we choose to make. We don't have to, but we very strongly support the MISMO efforts and back a number of those programs to the MBA to make sure that we're all talking the same language and communicating in the same language, because that makes the industry stronger and more robust in the long run as well. But that's very unique. When we do business in other verticals, Rob, we don't see that as much. Typically, people come, they plug into our API, and there's not a lot of other moving parts into that relationship. We're still heavily focused on security, still heavily focused on data acquisition and data quality, but there's not the amount of maintenance and additional connections and things that we hold very dear and are required for the mortgage ecosystem to work clearly.
Yeah, the cybersecurity obviously is a huge topic. It doesn't come cheap. Just like, a lock, keeping your home secure. How much, at some point, you have diminishing returns with the number of locks you can put on an apartment door, for example. You see some of these comedy movies where they close the door and just like cha-chung, 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 and then they turn around and the thief is inside with them. The cost is an issue when you're talking about these things. Does the introduction of more scores actually lower the cost for a lender, or do they add a layer of model risk or tech implementation that of costs that the industry isn't ready for yet?
Great question. Great question. And I will tell you, I will jump back to the cybersecurity piece just to state, I had a couple of conversations this last week at MBA with a few banks that, they have really doubled down on looking at security again, as have we, because of, some of the things going on over in the Gulf area around Iran. It's no secret. I'm not speaking for our company right now. I'm speaking in general. It's been well known that cyber attacks have really skyrocketed in the last few months, and kind of aligned with that activity. But that's why investing and making sure that we do have more than one lock on the door is important, so that when something like that happens and it amplifies quickly, you're ready and you're protected. But in regards to some of the question in regards to the credit reports themselves, and are the scores going to drop the price overall and the cost? There is absolutely a cost when there's change. And so I've heard many people refer to as this being credit score chaos. I don't know that I subscribe to that. I think that change is good. I think that there's going to continue to be more scores probably introduced into the equation. But there are some technology challenges to make sure that flows smoothly. In regards to the underwriting and the risk, that really is, that there's kind of a line there that's going to be looked at differently. So if you look at the GSEs and how they're evaluating the risk of a loan and whether they want to partake in that loan and back it, they're actually not using the score today. They use the trade lines and use that to make that decision. They do use the score to price the loan. So, in the change of a score right now, are we opening up the door for massive chaos in regards to risk modeling? No, I don't feel that way at all. The question does come down to, is there going to be a difference in pricing? And is it going to be a situation where that causes people to behave differently, or does it impact a Fannie or Freddie's overall revenues or security based on the fees there? There will be some questions on that. I think that they've taken a very diligent approach, though. Again, I'm aware, and we've participated in them doing pretty exhaustive data reviews of looking at how would the scores perform through the last mortgage crisis. And they've been looking at what makes the difference in the score. So if Vantage is always coming in 40 points higher, what's contributing to that? And they're getting, the comfort level in that space is what's important to happen. And that's why they're starting, with a proof of concept to prove that out with lenders, get more and more comfortable. But I'm delighted that everything I'm seeing from the data coming back in is that it's all been very, very positive. And I think you were at the same breakfast I was on Monday morning. And we even had an investor talk about that. They've analyzed it and think that they're very close, but there will be some pricing benefit with the new score from Vantage, and that's a good thing for the industry. I have no doubt that when 10T is available, it's going to provide a different score model for those people that have utility information, have rent information, have that additional data that's going into that score, which is why it looks different than the classic score. But in regards to the cost, we fully believe, based on all the models we had, that the shift is going to save the industry $1 billion, one way or the other. Even if everyone decides that, even if the pricing of the two scores gets equalized and everyone wants to buy FICO 10T and it helps more people get approved, that's a win for the industry. That's a big win for the industry. Again, we believe that's $1 billion. We're very confident in our score, and we know that Vantage will deliver. And for clients that that choose it, we're excited to see that going forward, and we know that it's gonna help the industry. What's exciting to us on the Vantage front is, sharing some real numbers, is October 1 of last year, which October 1's an important date because that's when FICO started making some of their announcements about changes and such. We had 2 clients in the mortgage space that were pulling Vantage. That was it. We had 2, and that was it. By the end of March, we had 260 clients that were pulling Vantage, getting both scores. They were getting both the FICO and the Vantage score, getting comfortable with it and comparing it. We had 42 clients of that population that were only pulling Vantage. So on their home equity line or their pre-qual. So they may have pulled FICO before closing the loan, but they were using that differently. And so from my perspective, that's a very positive, is that we're seeing the industry really try it and turn it on. But the biggest jump we have seen has been in the last 3 weeks since the proof of concept got announced. That 260's gone up north of 410 now of people that have turned on Vantage to start testing and using it. So we have 410 lenders that we at Equifax see that are now getting Vantage.
Yeah. Wow, that's quite a increase that Equifax has seen. And you brought up one point that I just heard, and I'm not a credit expert, although I play one on TV. Actually, people tell me I've got a face for radio. But that all aside, the fact that the agencies do not use the credit score in their loan process, that they look at the trade lines, but they don't look at the credit score. Am I getting that right?
That is it. Yes, they use the score for pricing the loans, and of course, lenders use the score to identify whether that loan should go to a GSE or whether they need to be looking for more of an FHA type of loan, or even to hold it themselves. But yeah, in the black box, which I don't know what all is in the black box, but I do very thoroughly understand the score is not part of the risk model.
Very interesting. So, if somebody who's listening to us chat on this subject, some kind of stakeholder, whether you're a lender or vendor and so forth, and their only goal is to reduce their cost, because that's a big thing. I mean, it still costs about 12 grand to produce a loan for the MBA. So, reducing costs is obviously very, very important. So if their only goal is to reduce their cost, in that kind of mentality, that's like, oh, I'm going to run my tires on my car an extra, 1,000 miles. Well, there's a potential cost to that. You see it all the time in the swerve marks on the freeway. But in terms of credit, if somebody's only saying we need to reduce cost, we need to reduce the cost of credit, what one thing would you say they might be ignoring, if that is their directive, that could come back and bite them?
It's a great question, and it really depends on each customer, to be perfectly honest. So, what we know, and again, I'm not trying to be the expert. I learn from our customers and their behaviors. What we know is that many clients will get an applicant that's an 800, and they still will go ahead and pull the second and third rather early in the underwriting process, because they are concerned that if 800 is the top one and 760 is the low one, they may get into a little different LLPA table box that forces them to reprice that loan, and they don't want to have to do that. And so they will invest to make sure they're putting their best foot forward. And I think that's an important mindset for folks. But the number one answer to your question is, if you're not talking to your credit vendor, whether that be Equifax or whether that be any of the CRAs that are providing tri-merge and single file services on behalf of the three national credit bureaus, if you're not talking about this with them and asking not just the question of price, but what can you be doing different from a business flow or from a strategy of how you're using credit and how you're using verifications, you're probably missing some pretty good opportunities. And again, I'm speaking only for us, but we are really excited to have clients that want to collaborate. And we often will end those collaboration sessions by making recommendations that our revenues go down. Because we'll find that they're doing something that doesn't make sense. Outside of the credit world, in the verification world, we found a client that was repulling VOI every 30 days on a loan. And that's really expensive. And they weren't even really aware that was in there. So challenge your provider to be a partner. And if they're not, call me. I'll do everything we can do to be a partner. But I think that's the first step. Is the one thing that I've really taken away from the last year of all of the debate and all of the public conversations and all of the conversations we've had in DC is that there is a lack of understanding of how the credit bureaus work and options around how you could use credit to get to a better outcome. And so there's so much opportunity for education. I really would encourage folks that as much money as credit does cost is to hold your partners accountable for helping you analyze your spend, where your waste is, and what those opportunities are, and to do it in a way to control that cost better. And there are some clients that are embracing a model where they just roll up all the cost and charge it on a closed loan. That's their choice, but they're probably not actually driving efficiency or bringing that overall spend down. They're just rolling it up for the loan that closes.
Yeah, I was going to ask you, given since let's just you mentioned October 1, I was going to ask you if since that time have you been surprised with the way the market has gone? And it sounds like you have been to some extent, but Washington D.C., whether they're regulators, whether they're politicians, being in the press as much as credit is these days, do you think the regulators and politicians view you as partners in home ownership, or are you being treated as a kind of a utility that needs to be regulated and made to lower your price?
That is great, right on the nail question there, and I'll answer it. Probably get myself in trouble. I might get feedback on this one after the fact, but um, there's no doubt that there is a focus, and it's an appropriate focus of how do we drive cost out of the whole process. And so there's been a lot of talk about credit. So it is a target. What I will absolutely compliment many of the departments in the government and many of our representatives is they've been open to learn. They've been very open to learn, and they have great questions. And what they don't like is being misled. They want the facts, and they embrace the facts, and they want to learn. And we've really, honestly, not seen that much interest. Now, there's not been the escalation, but I spend at least 3 or 4 days a month in DC, meeting with all of the different parties, and there are hard questions that we're expected to answer, which we do. But the vast majority of the conversations are based around education and alternatives and options. And so, as part of that, we talk about everything. We are open to talk about affordability on every front. We're open to talking with some of the organizations. We had conversations about the concept of not using a score at all, and using a direct pipe into the black box to determine whether the loan's going to qualify or not. We've had all of that dialogue, and we're here to support what's best for the industry to make those things happen, and to ensure that we're delivering a quality product that is as best as it can be, and helps people get that job done with the least amount of human touch. Because as you know from the numbers you were quoting of $12,000 to generate a loan, the biggest chunk of that is still a lot of manual labor work done to get that loan. And so I'm not deflecting there. I'm just saying anything we can do to make sure that that work is minimized as much as possible on a credit front or a verifications front is a win for that originator.
Yeah, well, that's a good way to wrap up the show. Joel, I wanted to thank you very much and thank Equifax very much. For being on the show, Equifax for sponsoring the show. I think that there's a lot going on, and you shed a good light on much of it. And I think that education is so important, and keeping kind of in front of the industry and saying, wait, eliminating some of the misconceptions that might be out there is huge. So once again, thank you to Equifax. Joel, thank you for being on here for 45 minutes, and thank you for folks who tuned in.
Well, thank you so much. I appreciate the opportunity, and knowledge is power. We're here to help educate people and be as transparent as we can and help them make the best decision for them. So thank you so much for letting me be part of this, and we appreciate you.
All right. Thank you.